Budget versus actuals is hands down the most valuable financial report. In fact, in almost any board meeting that I sit in on, this is where we spend the most of our attention because there's so much value in this report. Here's where you get to have a discussion on where exactly you thought the business is going and how that may deviate from what's actually happening. And if you nail down this report, you'll understand your business like you never have before. So in this video, we're gonna cover how to prepare a budget versus actuals, how to dive into the details of this report to provide the right commentary, and then finally, we'll cover 8 different ways that you can present your budget versus actuals. And before you can create a budget versus actuals, well, you actually need a budget. And if you're using QuickBooks Online, watch how simple it is to do that. I'm using this tool called Model Wiz, and if I just click on Forecast Templates and choose Basic Financial Model, I can hit download and my data is instantly going to be pulled in from QuickBooks Online and shaped via all these different beautiful tabs and exports. So you can see that everything is just automatically getting printed and my data is getting transformed. And now in just a matter of seconds, I have a full budget where I can understand where my company has been across all 3 of my financial statements. And what's really cool is I don't even need to manually bring in the data from Excel each month as I roll forward. I can just choose this roll forward button and all the information will automatically just get roll forward directly into my file with any new accounts. So what I love about this is it's entirely in Excel and you have the ultimate flexibility while utilizing the data directly from your QuickBooks. And if you want to try us out, you can do that at modelwiz.com entirely for free. All right, let's now continue with our video. So let's get started first with what exactly is a budget versus actuals report. What if I could provide you with a crystal ball that showed you what the future was going to look like? How much would you pay for it? My bet is a lot. See, the uncertainty of the future creates a lot of risk, and that risk can be really expensive. So the more you understand about the future, the less risk and the less expensive your decisions. And that's exactly what a budget versus actuals is. It starts with you creating a budget for what exactly you think the future could look like. And then each month, as you actualize your model, you get to understand how close you were to what you thought was going to happen versus what actually happened. Now, you shouldn't expect to have 0 variances. In fact, that's pretty rare. You'll always have variances. The future is totally unpredictable and things like market forces can cause variances that are impossible to plan for. But what is important is that you have a full set of commentary on what exactly is going on. And that to me is why this report is so valuable. See, your job as a finance and accounting professional is to steer the ship. You're in control of what's happening financially with the business. And if you don't have a tight grip, you may suddenly one day wake up to the fact that there's a hole in your boat and the ship is gonna sink. I've seen that happen many times. CEOs who didn't realize that their runway was a lot shorter than they thought. And because of that, they had to go to their investors and raise capital at a really unfavorable valuation just to make payroll. Really stressful. The budget versus actuals report allows you to keep yourself in check each month by seeing how far your variances are. And with each variance, you get to understand exactly where in the business you need to perform a deep dive. This one report shows to leadership, the board of directors, really anyone in the company that you have a pretty tight grip on what exactly is happening in the business. And that could unlock some incredible insights, like who the company can hire or what their conversion rate needs to be via different funnels in order to hit their sales objectives, or most importantly, when the company may run out of cash. But before you set up a budget versus actuals report, you need, well, a budget. Now, when you hear the term budget, you may also hear the term pro forma or financial model or forecast. And for the most part, they all pretty much mean a set of projections at a specific point in time. So that can mean projections for just a segment of the business, like your sales or expenses, or more commonly, it can relate to a projections prepared via what's known as a 3-statement model, which includes the income statement, balance sheet, and cash flows. And if you're looking to learn how to prepare a 3-statement model that'll add tons of values to your career, you can check out my course on financial modeling fundamentals. You'll learn the do's and don'ts of setting up a forecast, and you'll build one with me entirely from scratch while getting access to tons of different templates. Check out the course right here. Okay, so back to the budget. The word budget typically means that it was reviewed by key stakeholders and then signed off on. That means that you'll save down a separate version of your forecast at a specific point of time, and you won't make any changes to the lockdown version. Now, this is typically done at least once a year, but it's pretty common to do this as frequently as each quarter, depending on the size of the company and how often the board of directors meet. So now you have two versions of your forecast. One that's locked down, which we'll call a budget, and one that you'll continue to be updated each month, which we'll call a rolling forecast. And that's a key concept, actualizing your financial model. See, the best financial models don't just tell the story of where the company is going. They also tell you the story of where you've been by including actuals from your accounting software. And that's key because each month in your rolling forecast, you're gonna wanna roll forward your forecast with a new set of actuals. So your rolling forecast and your budget will start off with having the exact same data when you first save down your budget. But then each month, as you actualize your rolling forecast, you'll start to have variances from what you thought was going to happen and what actually took place. And that's what's all shown via budget versus actuals. And as you compare your variances each month, if they're minimal and you feel like everything is still aligned with what you thought was going to happen, then you can continue to repeat the process each month. But if you detect that all of a sudden there was a serious variance because of an error that you didn't realize, well, that's the opportunity for you to then suggest that you should save down a new version of your budget. It doesn't make sense to continue comparing against a stale version of your budget if you know that there have been significant changes in the business. The key is to strike that perfect balance between having a locked down budget that you compare to each month to hold yourself accountable to while also being flexible enough to save down a new version of the budget when you feel like the current version no longer reflects reality. Okay, so you saved down a budget. You've now rolled forward your rolling forecast with the new month of actuals. How do you now analyze and communicate your budget versus actuals? Well, most people make the mistake of taking every single account that they budgeted and then they prepare variances that they then show to stakeholders with that full list. But there are a lot of issues with this approach. The biggest one is that it's just data overload. This is part of a bigger topic on a separate video I'm gonna make about financial storytelling. But the key here is to remember that these stakeholders that you're presenting this information to, well, they most likely have a ton on their plate. The CEO is probably in between meetings and is thinking about a million other topics. The board of directors are thinking about all the other companies that they may sit on the board of. You need to find a way to communicate the most important aspects of what went wrong and what went right without overwhelming them with too much data. So I like to first start by outlining the most important areas of the business. Ideally, I just show enough metrics that I could showcase in one snapshot or a dashboard. And I'll start at this level so that I could then get instant feedback on where I need to do a deeper deep dive. Again, if the information shows a very minimal variance, I most likely don't need to study all of the accounts that tied into this area. If I see a large variance, I'll drill down to see what accounts make up that variance. I'll then compare them side by side at a detailed level. If I see that there's a significant variance in, say, my legal fees, I'll double click into my accounting software to see what exactly makes up this balance. This is why I'm such a big fan of understanding the accounting side of things when working in FP&A. The more you know about how financial statements are produced, the more you can speak to the variances and ideally plan for a correct future. I'll then study what our assumptions were when we prepared our forecast for this account. Is the variance because of a timing difference that's going to reverse itself in a future period? Is the variance because our assumptions were overly aggressive or maybe too conservative? Or did we have an error in our forecast? Hey, I've been there a bunch of times. And if the budget was prepared with department owners, I'll also schedule a meeting with them to hear their thoughts. All of these details will then get outlined in a separate document to create a full story of what happened and most importantly, why it happened. I'll then put this full story into an email to a client, or maybe I'll save it for when I'm presenting live in front of leadership or the board of directors. And it's with that story that I could then suggest whether we continue comparing against the original budget that we saved down earlier, or whether it's time to save down a new version of the budget. And notice on my budget for variance, I'm not only showing the variances on the dollar level, I'm also showing it on the percentage level. Because in order for me to understand the materiality of a variance, I need to really understand both. And notice that for variances, I'm showcasing all good variances as positive and all bad variances as negative. That means that for my income accounts, I'm taking actual minus budgeted as my formula. Because if I did more in income than I did in my budget, that's a good thing. For my expenses, I'm doing the exact opposite. I'm taking budget minus actuals. If I have more in expenses than I budgeted, well, That's not a good variance. So this makes it really easy for the readers to understand where are the good variances and where are the bad variances. Then for the percentage variance, I'm taking the variance divided by the budget. But that's not enough. See, my budget may be a negative number, which means that if my variance is positive and I divide it by a negative, well, that may then cause a negative variance, which violates our rule. So I'll always divide by the absolute value of my budget. And then similarly, when I divide these two together, if my budget was 0, I'll get a scary divide by 0 error. So instead, I always wrap it around an if error, which will return 0 if there's an error. So now that we're familiar with how to present a budget versus actuals, let's go over 8 creative ways that we can showcase them in Excel. All right, first up, we got a good old-fashioned table. Now again, notice that I have the key areas of the profit and loss. I also have some cash flow metrics. Then I show the budget, actuals, dollar variance, and percentage variance. Now, if you want, you could also use some conditional formatting to put in red, bad variances versus good variances. Next up, the KPI box. Now, I love this because you're not limited by what's already available in Excel. This is made with entirely custom shapes and text boxes, and it's really just pretty. And if you want to know how to create a KPI dashboard like this, you can check out this video, which I'll include a link to in the description. Okay, next, the donut chart. This is my favorite way to show budget versus actuals because I not only get to showcase the text, but you could also see the percentage shading to help understand a lot more easily the impact of the variance. And now you can take this one step further if you want and build a speedometer chart, like the one that you see over here. Okay, now let's take a look at some bar charts, starting with this bar with a cutoff line where the bar chart showcases actuals and the cutoff line showcases budget. Okay, now we have a custard bar chart. This showcases budget in one series, actuals in another series, and then if it's a positive variance, the gap will be filled in blue. If it's negative, it'll be filled in red. You could also showcase a waterfall chart where you have the budgeted amounts and then you see which amounts contributed to positive variances versus negative variances to get to your actual amount. And then this thermometer chart is also pretty creative where again, you can showcase positive versus negative variances in blue or red. And now that you're well equipped in managing the budget versus actuals process, it's time to build a beautiful dashboard that will make your reporting come to life. And for that, you can check out this video right over here. I'm Josh, your CFO guy, and I'll catch you in the next video.